Employee stock purchase plans, ESPPs, are one of the most common pieces of executive compensation at public companies, and also one of the many that are misunderstood. Most executives who participate in companies' ESPP plans think of it as a straightforward 15% discount. Some of them are right, some of them are being taxed twice on the same income and don't know it. You might have heard of them described as free money, or as a no-brainer benefit, or as an easy 15% return. None of that is exactly wrong, but none of it is exactly right either. ESPPs are a tool. Like any tool, whether you should use them depends on what you're trying to build. In this video, I want to walk through what an ESPP actually is, clear up a few common misconceptions, and give you a framework for thinking about whether and how much to participate, because that decision isn't the same for every executive. I'm Klemm. I'm the founder of Inflection Point Wealth Management. This is video 5 in our informational series on executive compensation. If this video on ESPPs is relevant to you, be sure to subscribe so that you see more content that will also be relevant to you. So far, we've covered restricted stock units, non-qualified stock options, incentive stock options, and performance share units. This one is ESPP, or employee stock purchase plans. The mechanics are simpler than the options on the surface, but the decision of whether and how much to use your ESPP is more nuanced than most content acknowledges. Same framework as always. What is it? Where do most people get confused? And how should you think about it in the context of your full plan? An employee stock purchase plan is a company-sponsored program that lets you buy your employer's stock at a discount through payroll deduction. The most common structure, and the one we're going to focus on today, is what's called a qualified or 423 plan. That's the one the IRS gives preferential tax treatment to. Many company ESPPs are qualified plans. Here's how the mechanics work. The plan runs in offering periods, most commonly 6 months long. You elect a contribution rate, usually a percentage of your salary, typically capped at 10 or 15% by plan design. Those contributions come out of your paycheck on an after-tax basis throughout the offering period. At the end of the period, the accumulated contributions buy company shares at a discount to the market price. The discount is capped by law at 15%. Most qualified plans go right to that cap. Some plans add a feature called a look-back, which means the 15% discount is applied to the lower of two prices: the price at the start of the offering period or the price at the purchase date. If the stock price goes up over the offering period, a look-back gives you effectively more than a 15% discount. If the stock price goes down, it still gives you at least 15%. Not every plan has a look-back. Check yours. One mechanical detail that matters for executives specifically: the tax code caps the amount of ESPP stock you can purchase at $25,000 of stock per year, measured at the offering date price. That limit is per person, per year, and for executives with a solid salary, it's often the binding constraint. You'll hit that $25,000 ceiling before you hit your plan's percentage of salary cap. Know where your ceiling is. Before we get into the framework for thinking about whether to participate, let me clear up 3 things I hear regularly from executives trying to understand their ESPPs. Most of what's out there on ESPPs is written to encourage participation, not to help you understand what you're actually buying or what the tax treatment actually is. These 3 misconceptions are where that gap shows up most clearly. Misconception 1: there's no tax at purchase. This one is technically true, and it's also misleading. You don't owe tax on the discount on the purchase date. That's correct, but there is a tax event later when you sell the shares, and that tax treatment at sale is more complicated than most people expect. Think of ESPP as a tax deferred on the discount, not tax-free on the discount. The IRS comes back for their share. Misconception 2: a qualifying disposition means capital gains treatment. Also partially true, also misleading. The qualifying disposition is when you've held the shares at least 2 years from the start of the offering period and at least 1 year from the purchase date. On a qualifying sale, only the gain above the discount is taxed at long-term capital gains rates. The discount itself, or more precisely, the amount of the discount you would have gotten at the offering date price, is still ordinary income. The qualifying disposition doesn't convert the discount rate into capital gains. It just treats any additional appreciation beyond the discount at the more favorable rate. That's a real benefit, but it's a smaller benefit than the word qualifying makes it sound. Misconception 3: it's free money. The 15% discount is economic value, and on a stock that's going to perform well, it's meaningful. But a 15% discount on a stock you wouldn't otherwise buy at full price isn't the same thing as free money. That's the piece that gets lost in most ESPP content. The discount is a feature. The underlying share is still a share of your employer's stock with all the same concentration and investment quality considerations as any other share of that stock. Treat the decision as an investment decision first and a tax or benefits decision second. So the question most executives actually want answered is, should I participate and how much? The honest answer is, it depends. And the 4 things it depends on are these. First, your existing concentration in your company stock. If you already have meaningful RSU grants vesting every year, outstanding stock option grants, PSU awards that might pay out, and shares you've accumulated from previous equity vests, you already have material exposure to your employer. Every ESPP purchase adds another slice to that pile. For executives who are already at or above where they want to be on company stock exposure, the ESPP adds concentration they don't want. And the 15% discount doesn't fully compensate for that if the position is already uncomfortable. Second, your goals. What is the money for? If your ESPP contribution is competing against a 401k match that you haven't fully captured, an HSA you're not maxing out, debt you could be paying down, or a near-term cash need like a down payment or tuition payment, the ESPP may not be the best use of that dollar. The 15% discount is real, but it's not the only thing competing for your paycheck. Third, your conviction in the stock. This is the one most executives don't let themselves think about directly. Would you buy the stock at full market price with your own after-tax dollars? If the honest answer is yes, then buying it at a 15% discount makes the math even better. If the honest answer is no, or not really, then the 15% discount doesn't fix that. A 15% discount on a stock you don't feel good about owning is still worse than paying full price for a stock you do feel good about owning. Executives are often closer to the company than they'd be willing to be on an outside stock, which can cut both ways. Fourth, cash flow. ESPP contributions reduce your take-home pay across the offering period. For executives who have variable pay, quarterly estimated tax payments, and other competing cash flow demands, committing a meaningful percentage of salary to payroll deduction can create pressure elsewhere. Whatever you contribute has to be sustainable alongside the rest of what you're planning for. Put those 4 together and you have a more honest answer than just participate to the max. For some executives, the answer is participate fully. For others, it's participate partially. For others, it's maybe skip it entirely for now and revisit next year. None of those answers are wrong, they're just different answers for different situations. If you do decide to participate, there are 2 practical things worth understanding that most ESPP content skips over. First, the tax benefit from a qualifying disposition is often smaller than people expect. Say you buy 200 shares at $85 when the offering date value was $100, and the stock is also $100 on the purchase date. Your discount is $15 per share, or $3,000 total. If you sell right away in a disqualifying disposition, that $3,000 is ordinary income. If you hold long enough for a qualifying disposition and later sell at $110, the ordinary income is still $3,000, and only the additional $10 per share of appreciation is taxed at long-term capital gains rates. On 200 shares, that is $2,000 taxed at long-term capital gain rates instead of ordinary rates. At a 37% ordinary rate and a 23.8% long-term capital gain rate plus net investment income tax rate, that tax savings is about $264. That is real, but it may not be enough to justify holding a concentrated company stock position longer than you otherwise would. Second, and this is the part that causes real filing mistakes, the cost basis on Form 1099-B is often incomplete for ESPP shares. The compensation income may already be reported on your W-2 in the year of sale, but the 1099-B may still show only the amount you paid for the shares. If you enter the 1099-B without adjusting basis, you can end up taxed twice on the same discount. The IRS may not automatically fix that for you. You or your preparer may need to adjust the basis on Form 8949. For executives selling a full year's worth of ESPP shares, the double taxation mistake can cost $1,000 to $3,000 or more in unnecessary taxes, paid because the 1099-B showed the wrong number and nobody caught it. Here's the through line on ESPPs. They're a tool, not a no-brainer. The 15% discount is real, the look back can make the discount effectively larger, and there's a legitimate case for using them aggressively in the right circumstances. There's also a legitimate case for participating modestly or not participating at all in other circumstances. What you want to avoid is making the decision on autopilot in either direction. The answer should fall on your overall plan, your concentration, your goals, your conviction in the stock, your cash flow, not out of a rule of thumb that says always max your ESPP or always skip it. Like every other piece of executive compensation, the ESPP serves the plan, not the other way around. Next video in this series, we're covering deferred compensation, which is a totally different animal with its own set of decisions to make before you ever put a dollar into it. If you're currently enrolled in an ESPP and you've never verified the cost basis on your ESPP shares before selling, pull up your last 1099-B and check whether the amount paid matches the fair market value on the purchase date. If it doesn't, that's a basis adjustment your preparer needs to make. It's a 10-minute check that could save you from paying the same tax twice. This channel is built for high-earning professionals and executives, delivering content on navigating complex financial decisions, equity compensation, tax strategy, retirement planning, and concentrated wealth. If these topics are valuable to you, be sure to subscribe so that you get more free content. Thanks for joining, and see you next time.